Well, good afternoon and welcome to everybody that's joining us from the CFA Society NZ, NZ Private Capital, Infins, and anyone else who's dialing into the call. My name's Alister Van Der Maas. I'm a independent consultant nowadays. The CFA Society's asked me to help moderate this session. Today we're joined by three good speakers. We've got Kelly Eckhold from Westpac. We've got Tina Huang from the NZIER. Ting is actually stepping in for Christina Leung, who's come down sick with COVID and a sore throat, so she can't make it. And we've got Hamish Pepper from Harbour Asset Management. So the format of today is it's really an economic briefing. We've got a sort of a focus of big picture global events that Kelly's going to talk to. We're going to talk about the New Zealand economy with Ting, and then Hamish is going to focus on the implications for portfolios and investors. We've got happy to take questions probably at the end. We're going to let each person speak for about 10 minutes, move to the next speaker, then we'll wait for questions at the end. You should be able to send through the questions on the Q&A in Zoom. So I'll be able to see those and see the thematic that's coming through and then ask each of the speakers their thoughts. Just a couple of reminders. Forecast lunch for the CFA Society NZ is coming up on the 8th of November. Don't know about you guys, but I'm keen to try and get a bit closer to winning this year. So I'm looking forward to as much advice as I can get from the people on the screen today about where we're going to see the OCR and interest rates and things like that this time next year. So without further ado, the first speaker is going to be Kelly. And Kelly is going to talk for about 10 minutes or so, and then we'll move through to Ting and then Hamish in that order. I'm going to jump on mute right now and pass over to Kelly. Kelly is still on mute, so if Kelly wants to unmute himself, that'd be great.
Mute. How about that? Good stuff. Okay, I'll just back up so you see that. Hopefully you can see that all right. So yeah, as I was saying, I'm going to talk about a few of the kind of key international trends that are sort of out there, sort of shaping markets and the New Zealand economy right now, focusing on a few of the key issues, opportunities, and a few threats out there for everybody to think about as well. So in terms of the kind of key issues that are really at play right now, I guess there's kind of like three main groups of them. The first thing is that globally, we're still looking at this period of quite subdued global growth, pretty much everywhere in the world. And it really is that kind of post-COVID hangover period. Where, you know, for a lot of jurisdictions through the COVID period, whilst there were fears that there was going to be a pretty depressed economic situation, reflecting the fears about what COVID was going to do, the reality ended up being somewhat better than that. So we ended up with quite strong growth and inflation pressures, and now we're looking at this long period of subtrend growth with interest rates rising and remaining higher for longer to try to bring inflation back under control. The other interesting thing that's going on right now, which is particularly important for New Zealand, is the China recovery, or especially the lack thereof of such a recovery. You know, there's real challenges there in China within their property sector. They've got relatively high unemployment, particularly in certain cohorts of the country, very weak consumer sentiment, and that's really flowing through to the New Zealand situation. And the last thing I'm going to talk a bit there about some of the geopolitical headwinds that are really shaping international economic trends, particularly the kind of like the rise of tension between the West and China and Russia as well. And the implications that's having for global economic and financial capital flows. So starting off with that global growth outlook, as I said, we've really got a very weak post-COVID growth outlook. My ex-colleagues at the IMF generally are relatively optimistic about global growth if you look forward, but at the moment they're showing as weaker outlook for global growth as they've shown since the GFC. So I stole this chart here on the right-hand side from the Financial Times a couple of months ago. Hasn't really changed that much, but you can see there on that red line that basically there's not really very much in terms of an acceleration of global growth expected. Basically just over 3% across the world, which is not particularly fantastic compared to what we've generally gotten used to over the sort of like the 10 years post GFC. The other thing about the international outlook that's interesting and relevant to us is there's been the real big shift in consumption patterns, particularly away from goods and towards services. So during the pandemic, when a lot of people were working from home, there was a lot of consumption of goods because we were all at home and we couldn't go out and about and enjoy a lot of the services. But now, basically, in a lot of jurisdictions, people are really taking the opportunity to catch up on some of those experiences and things that they weren't able to do in the last few years that they can do now. As I mentioned before, a consequence of the significant stimulation that went through into economies through that COVID period has been a legacy of high and persistent inflation. And even today, if you caught up on what the FOMC told us in terms of the US economic outlook, they've significantly upgraded their growth outlook. They haven't really upgraded their inflation outlook that much, but they remain very concerned that interest rates need to remain quite a lot higher for a lot longer relative to the sorts of levels of interest rates that we got used to post GFC. And that story is relevant just about everywhere, possible exception of China right now. So that's three pretty important global trends. The particular kind of issue that I wanted to point you to here is the special case of China. It's pretty important for us because China is such an important trading partner. And what we see there is that contrary to expectations earlier in the year, where there was a view that Chinese GDP growth was going to bounce back quite strongly as their COVID restrictions were released. And in particular, there was going to be a move to consumption sort of like led growth as the Chinese got out and about and enjoyed a lot of things that they weren't able to do. The reality's been quite different. So this chart here shows you the evolution of expectations for growth in the Chinese economy this year and next year as we've gone through the year. And the trend has really been towards trimming back expectations about what we can expect from that Chinese economy, particularly for next year, but increasingly for this year now, to the extent to which I think if I updated this chart today, it would say many forecasters are even skeptical that Chinese will be able to deliver on their 5% GDP growth target that they have for the country for this year. And the outlook for next year is particularly weak. A big driver of what's been going on there has been a particularly weak labour market, a significant overhang of property and housing in the property market. And we've got a situation in China where with respect to youth unemployment is somewhere between 21 and 45%, depending on how you want to measure it, which in any economy would cause a significant degree of concern amongst households. And we see that reflected in Chinese household behavior, particularly with respect to their savings, where they are increasingly holding on to the funds that they have. They are not spending them because they're concerned about the outlook for the economy. They're perhaps concerned about the welfare of some of their wider family members when you've got that situation where unemployment is very high. How that's being reflected in New Zealand is obviously reduced demand for a lot of the goods and services that we would normally look to export to China. One of the interesting things that's going on in China, in contrast to the rest of the world, is Chinese inflation is actually negative right now. I mean, almost every country in the world is still grappling with relatively high and persistent and quite variable inflation. But in China, prices are either flat or going backwards. And that really tells you something about the extent of the challenge that the Chinese authorities have at the moment. They probably have an output gap, which is basically more like about 2 or 3% of GDP. And when you're in a situation where you've got a very large output gap of that nature, it generally is going to require fairly significant initiatives in terms of monetary and fiscal policy to be able to turn things around really reasonably quickly. So the implication is that our expectations in terms of what we might expect out of China for the foreseeable future is pretty modest. The last point I want to talk to you a little bit about is the geopolitical headwinds out there. This is something that's really been brewing for 7 or 8 years now, really came to a head with the Russian invasion of Ukraine earlier last year, but even sort of like 5 or 6 years earlier than that when the Crimea annexation occurred. And what we've sort of tended to see now with respect to the use of the trade and the payment system and capital market access is that it's increasingly being used as a geopolitical influencing tool out there. So there's a couple of interesting charts there I sourced from the IMF, basically showing how things like trade restrictions and in particular the actions that corporates are taking to kind of bolster their supply chains is being reflected in terms of sort of like trades and capital market trends. And increasingly what's been happening out there is that firms are no longer just looking around the world for the cheapest place to either buy the stuff that they need to buy, or they're just selling stuff to the highest bidder. They're thinking about, well, how resilient are those supply chains and those markets going to be in the event that geopolitical issues crop up to limit my ability to be able to do the sort of things I want to do? And I guess, the example that I'd like to tell you is the example of Germany with the start of the Russian war. And if you'd have been told at the start of 2022 that by the end of 2022, Germany would not be importing Russian oil or gas, that their technology companies would not be exporting things to Russia, you would have said that would be impossible. But the reality is that that is exactly what occurred when that Ukraine war kicked off. So what are the implications for New Zealand businesses of all of this? Well, I mean, the reality is we've got pretty weak demand for commodities at the moment because that Chinese market is not there for us. There's been a very significant fall in agricultural commodity prices and log prices. And that's representing a fairly significant in terms of trade shock that is really acting to kind of break growth and probably will continue to break growth for the next year or so. But on the other hand, there are some opportunities out there. Monthly visitor arrivals are still picking up. We're sort of about 2/3, I guess, or 3/4 of the way back to pre-COVID type levels. And that reflects those global trends towards greater consumption of services, less consumption of goods, and that means that New Zealand as a tourism destination is something that is pretty attractive and something that is actually adding some support to the economy right now. But in terms of those geopolitical and supply chain issues, what is really going on there is that we're seeing this kind of like move towards friendshoring, a greater focus on resiliency in supply chains. And the implication of this is higher and more variable costs, less flexibility, and in economic terms, it's that more inelastic supply curve, which basically means that prices you should expect to be more responsive to demand shifts than what might have been the case, sort of like for the 20 or even 30 years prior to this. Bottom line is higher and more variable inflation. We do have a lot of very elevated cyclical risks right now. The commodity price cycle is the one that's particularly front of mind, and that does raise the potential of exchange rate risks as well. What we've tended to see in this tightening cycle from the Reserve Bank is that it has not been reflected by an appreciation of the exchange rate, which is somewhat interesting. And that does largely reflect the fact that the terms of trade has been going against us. It basically means that we've seen a small depreciation in line with what the terms of trade has already done. And, there are some real risks there that we get a further leg downwards if that Chinese economy really doesn't perform over the next 6 months or so. So a lower terms of trade tends to be associated with a much weaker exchange rate. That's a double-edged sword. On one hand, whilst the internationally orientated sectors may see some benefit from the exchange rate, it does mean more tradables inflation and a harder job for the Reserve Bank to bring down already very high inflation back to the target range in an expeditious manner. So that's the nature of the slides I've got. I'll stop sharing now and we can move on.
All right, thank you very much, Kelly. So for those of you that joined a little bit late, what we're going to do is we're going to have each speaker present. The questions will queue up in the Q&A, and then we'll address those questions after each one of our speakers has had their presentation, and hopefully they'll all contribute to the answer to those questions. Okay, so next up is Ting Huang, Senior Economist from the NZIER, thankfully stepping in for Christina today. So we're going to pass over to Ting, who's got a great presentation as well.
Thank you, Alister, and thank you, Kelly, for the very informative presentation, which leads on to very well for mine. So I will start sharing my screen. Hope everyone can see. So I'm Ting Huang, a senior economist, and I work with Christina Lung in delivering our long-established quarterly survey of business opinion, as well as quarterly predictions. So in absence of her, I will present on the key takeouts from our latest quarterly predictions on the New Zealand economic outlook. So already mentioned by Kelly that we are seeing this slowing economic growth. So this once again has become a key influence on New Zealand's economic outlook, particularly in regards to the slowing Chinese economy and the implications for export demand here in New Zealand. These downside risks add to the already dampening effects of high interest rates on growth, with retailers feeling particularly downbeat in the face of softer demand. But despite the slowing in demand, inflation in New Zealand still remains elevated above the Reserve Bank's 1 to 3% inflation target band, although it is still moving in the right direction given the easing in capacity pressures. So I will talk a bit more about what's happening in the export market, especially dairy. So the slowing growth in China has been weighing on demand, especially for dairy products. And global dairy prices fell sharply in recent auctions, driven by a combination of weaker demand from China, but as well as increased supply volumes by Fonterra. So this continued decline in global dairy prices led Fonterra once again revised down its milk price payout forecast for the 2023 to 2024 season to a level of $6.75 per kilograms of milk solids. And this is lower than the average break-even milk price estimated by Dairy New Zealand of $7.51 per kilogram of milk solids. This gap between the price and the break-even payout suggests that dairy farmers on average will be making a loss over the coming year, even though dairy farmers have been cutting back on their spending due to the intense cost pressures. So this adds to a new challenge to the already downbeat New Zealand economy. And then we're seeing households and businesses are more cautious about spending and investment. Retailers feeling particularly downbeat in the face of weaker demand. So around 60% of the retailers that we surveyed in our NZIER quarterly survey of business opinion, they actually expect a worsening in economic conditions over the coming month. So as the impact of high interest rates is still coming through, and retail spending actually fell for 3 consecutive quarters over December to June. So the slowing in retail spending is likely, we expect this will likely continue as the full impact of OCR increases to date continue to transmit through to the broader New Zealand economy. And probably you all know that with only about like 10% of mortgages in New Zealand are actually on floating rates, the transmission of monetary policy in New Zealand has actually been quite lagged. And around 50% of mortgages here in New Zealand will get refixed over the coming 12 months. So for many of these households, they will be actually rolling from some fixed rates of say 2 to 4% down to something around say 7% or higher. So we expect this significant increase in the mortgage repayments will further crowd out discretionary spending by households. And this caution towards discretionary spending is reflected in consumer confidence surveys, with households feeling very pessimistic about making big ticketing purchases. And we expect this will remain the case for the coming year, given the wave of mortgage refixing to come. Now, something relatively more positive is that there has been a strong recovery in net migration inflows since the international borders fully reopened last year. Provisional estimates by Stats New Zealand show that net migration gain reached a record high of 96,200 in the year to July 2023. The strong recovery is despite the net outflows from New Zealand to Australia, which for the 2022 calendar year totaled around almost 13,500. This means that we are more than offsetting this outflow to Australia by bringing people from other countries. But this strong recovering net migration will have both demand and supply implications for the New Zealand economy. So on the supply side, the most apparent impact has been on the easing in labor shortages. Over the COVID-19 pandemic, labor shortages had become very severe, reflecting the effects of illness as well as containment measures, including international border restrictions. So in that period, this led businesses to report finding labor as their top primary constraint. But now we are seeing sales supplanting finding labor as the top primary constraint for businesses. And the easing in labor shortages is particularly apparent for unskilled labor, as shown in our NZIER quarterly survey of business opinion. Strong net migration has also supported the increasing labor force participation, given migrants tend to have higher participation rate. So on the demand side, we're starting to see that the strong net migration is supporting a recovery in housing market activity. Other factors such as the loosening in LVR restrictions from June, as well as the increased confidence that there will be no further increase in OCR, will also support some housing demand. But for now, we are seeing this this slight pickup in housing sales as tentative, and they are mainly in Auckland and the surrounding regions. But we expect this pickup in the housing market activity will broaden across New Zealand over the coming year. And also this slight pickup in the housing market activity may lead to an increase in retail spending on items like furniture and electronics. So potentially offsetting some of the general decline in household purchases and big ticket item purchases. But over the longer term, while we expect that increasing housing demand and prices will encourage new housing supply, but in the near term, we are seeing a continued decline in the pipeline of construction, particularly when it comes to residential construction. And the latest building consents data in July showed us continued decline in the near-term pipeline of residential construction, but from a very high level. So it showed over 43,000 new dwelling consents for the year to July 2023. And this still points to a fairly solid level of residential construction pipeline. Actually, we have seen like the latest GDP data released this morning, and it points to a 0.9% increase in GDP over the June quarter. Although this was up from the previous 2 quarters, but comparing with GDP growth same time last year, it still points to a slowing in growth more broadly. So overall, we still expect a period of weak growth over the coming year, with annual average growth expecting to ease around or below 1%. Recently, we also looked at what data from Strategist tell us about financial health of New Zealand businesses. So first thing to note here is that there tends to be a lag between the direct impact of a recession on credit defaults and then onto company liquidation, because companies tend to do whatever, everything they can to prevent insolvency, which is more of the last resort measure. So looking across the industries, over the past year, there has been a sharp increase in liquidations in construction and transport sectors, reflecting the impact of COVID-19 on these fragmented industries. And credit defaults increased and the most in property and retail sectors, reflecting the impact of high interest rates. So how has the inflation in New Zealand been tracking? The easing capacity pressures in New Zealand, largely coming from the easing labor shortages, has driven a moderation in inflation over the recent quarters. But inflation pressures remain elevated, with annual CPI inflation still at 6%, which is still well above the Reserve Bank's 1 to 3% inflation target band. Core inflation measures is also elevated above 5%, particularly CPI excluding food, energy, fuel, which was higher than the headline CPI inflation at 6.1%. The continuous strength in food prices and housing-related costs remain the key contributors to high inflation in New Zealand. This is also reflected in the 7.2% increase in household living costs for the year to June 2023. The Reserve Bank's survey of expectations show that both the 2-year ahead and the 5-year ahead inflation expectations are still above the inflation target midpoint of 2%. So the key things emerging from our outlook is that weaker export demand adds to the dampening effects of high interest rates, but also on the upside, on the more positive side, strong recovery in net migration inflows is helping to alleviate labor shortages, but also there will be some sort of additional demand, especially for housing and just a broad range of goods and services. Overall, we still expect the Reserve Bank will keep the official cash rate at 5.5%. This is because, we think inflation is still elevated, so the OCR will need to remain at a restrictive level in order to bring inflation back towards the target band. but also because the full impact of OCR increases to date will continue to transmit through to the broader economy as households refix their mortgages at higher interest rates over the coming year. And also it is uncertain as to how the strong net migration and also the slowing global growth will play out on net on inflation. So it remains an uncertainty so it remains like the key uncertainty that the Reserve Bank will need to keep their eyes on for their future OCR decisions. So yeah, that's all from me. And I will pass on to Alister.
Okay, thank you very much, Ting. That's a pretty somber presentation there, following in the shoes of Kelly. We're going to move on to our next presenter, Hamish Pepper, who's a Director of Fixed Income and Currency from Harbour Asset Management. Hamish, it needs to be upbeat, positive. We're gonna tell everyone how wonderful things are going to be over the course of the next year. Then we're going to come back to everyone for some questions, and we already have a good queue of questions coming through. So keep them coming. Hamish, over to you.
Fantastic, thanks, Alister. Well, luckily I work in the fixed income part of our business, and you know, if it's a slightly dire outlook for the world, then it's a fantastic moment for fixed income and for bonds. But let me try and also talk beyond just that. Let me share my slides here. Yeah, look, I mean, firstly, whatever I'm going to say here, it's not financial advice. I don't know you. I wouldn't give it for that reason, and I can't give it because I'm not qualified to. So whatever you hear you might think is that, it's not that. It's good. That's done. There's a disclaimer at the end. You can read that. Lots of words. Look, okay, let's look back a little bit before we look forward, and maybe there's something positive in what we see looking forward. But looking back from a fixed income point of view, it was an absolutely horrific 2022. To be honest, it didn't matter what asset class you were in. Even if you were in cash, you got given an awful lot of trouble from inflation. So your real returns were likely to be negative. Here's a couple of charts just to explain what happened in bond markets. On the left, US 10-year treasuries. This is the cumulative change for each year going back to 1990. Dark line at the top is 2022. About 250 basis points of cumulative change last year. The worst for bonds over that period of time. New Zealand was no exception. I've just plotted the 2-year interest rate swap rate here. Doesn't go back quite as far, but you get a sense of just the kind of capital loss that fixed income investors experienced during that time. And so what happened? I mentioned that there was no place to hide. Well, this chart shows you the bright bars here, bright blue, focus on those. That was 2022. Your global equities hammered, New Zealand equities not far behind, global bonds, New Zealand bonds, everything was down. And, you know, it really caused people to question whether this whole idea of putting 60% of my portfolio in equities, 40% in bonds, you know, over time, that's fine. You know, I should do okay. When equities fall in value, I'll get a capital uplift in my bonds. Well, not when there's a massive inflation shocks that we'd experience and central banks having to respond to those. But I think let's look forward, and there's a bit of a more positive story here. The reset, at least in bond space, has happened. You know, fixed income now offers you yield, particularly in New Zealand, where you've got running yield on indices that, you know, we would commonly follow, for example, around about that 5%. Running yield in our funds, we like to have a bit more duration. We like to have our average maturity of our portfolios a bit longer than index. Well, we're getting sort of running yields up towards 6%. But it's the same when you go global. You know, global yields for, you know, just an index is around 4%. You hedge it back into New Zealand dollars, you know, you can get right up to about 6.5%. That's what we're getting for our Hunter Global Fixed Income Fund at the moment. So look, the long story short here is that yes, it was very, very painful last year for almost all investors, but including those in fixed income. But with that pain comes sort of a new outlook that bonds are something that offer yield going forward, but then also offer the prospect of capital gain should we get a shock that is negative in terms of negative to activity, or something that encourages risk aversion, encourages more demand for bonds going forward. So in New Zealand, there's a particular thing that I think encourages our view, which is to own, a bit more fixed income than you normally would. That's essentially our view. It's our view within the fixed income team. It's our view within our multi-asset services as well. And what is one of the key factors? It's this strange thing that New Zealand markets are essentially pricing monetary policy to be tight forever. This is a chart of 1 year interest rate swaps. Think about it as 1 year interest rates starting at forward years in the future. So 1 year forward, 2 year forward, all the way through to a 1 year interest rate that starts 9 years forward. All of those interest rates at the moment are above 4.5%. So even if you have a very different view of where neutral interest rates might be in the future, say they're 3 and not 2, say they're 3.5 and not 2, you've still got a market that's implying monetary policy to be tight for the next 10 years. And we just simply disagree with that. We think that underplays the prospect of a period of time where monetary policy might have to be stimulatory, might have to return to neutral. And indeed, if you look on the next chart, the RBNZ, as well as the Federal Reserve, don't get me wrong, the Federal Reserve this morning were hawkish. The press conference was very hawkish. But their forecasts were telling you a similar thing, that there will come a moment where monetary policy doesn't have to be as tight as it is today. If you look at this chart where essentially the RBNZ's forecasts at the end of their forecast horizon are over 100 basis points below the market, I think we are more on their page when it comes to how we see the next few years playing out. So we feel quite comfortable having our overweight, owning more than essentially the index has in this front part of the curve, because we think there will be a point at which monetary policy just doesn't need to be so tight. Now, of course, that's all about the sort of short-dated space. We would say that's out to about 7 years. Beyond that, in fixed income world, it's much more about the demand and supply of bonds. And so obviously recently we've had the pre-election economic and fiscal update from government. We've had debt management come out and revise up their bond program. I think what I would want to say here is, yes, we're cautious. That's not where we want to own sort of more bonds, so to speak, than the index would tell us to. But also that the market has an appreciation of the risk of this additional supply of bonds. Two ways that we would look at it would be where government bonds have been trading relative to swap rates. Bit of an unusual period recently, last 6 months, say, where bond yields have been above interest rate swap rates. Tend to think about government bond yields as being the true risk-free rate. The counterparty risk is not there. It's the government you're dealing with rather than a bank. But yeah, the supply risk has driven that relationship to be the reverse. Government bond yields are above interest rate swap rates, so a negative number on this chart, and around about 2 standard deviations for those of you who like Z scores below the sort of long-term mean. Again, when we look at where our bonds have traded relative to Australia, chart on the right, quite a big premium there for our 10-year government bonds relative to Australia, which is a reflective, it's a reflective dynamic of that supply risk. We've got two very, very different governments here. One in Australia running essentially fiscal surpluses, everything is fine. Ours running fiscal deficits and needing the bond market to fund it. But it is partly priced. So we're cautious, but we don't expect sort of a blowout, so to speak, in terms of our government bond yields relative to swap rates or relative to other governments. We feel like there is a degree to which it's in the price already. I think what concerns us more is around this concept of term premia. And of course, many of you will have studied this and will look at it probably a lot more carefully than we do here. But the long story short is that the decade or more of quantitative easing that followed the global financial crisis, which served to really suppress term premia. I'm showing you term premia for the US 10-year Treasury here. You know, that is now starting to unwind because essentially governments are moving and central banks are moving from a period of quantitative easing to quantitative tightening. And we're doing that at the same time that we've got these uncertainties, as Kelly mentioned, global uncertainties around inflation, around geopolitics, for which investors will want some compensation for. You know, that is really the essence of term premia. You know, what are you going to compensate me over and above some expectation of a succession of Fed funds rates? And so that is, I think, in many ways, a bigger factor in terms of our caution towards longer dated bonds than necessarily the supply risk that we face here in New Zealand. Just briefly on inflation-linked government bonds, look, we still like them. We still think the chart on the left here is the implied break-even inflation rate for essentially the kind of forward periods that we can calculate with these bonds. We're not like the US. We just have 4 inflation-linked government bonds. So the chart doesn't look very messy. It's just 4 lines. Maybe 4 lines is still too much. But anyway, there are the 4. So the blue one is the inflation that is implied. So the difference between the inflation-linked government bond and the nominal government bond of an equivalent maturity. We calculate that. It says that the inflation break-even is implied to be 3.1% between now and September of 2025. Yeah, I think the risks are that perhaps it's higher. It's not our base case, but the risks are that way. And so we like to own these securities because they will give us protection in an environment where inflation doesn't fall as conveniently as some assume. Again, you know, that forward period 2025 to 2030 that you can see on the chart there, inflation implied to be there at 2% at target seems a little convenient. So we'll own some of those as well for the risk that perhaps it's not as an orderly process and inflation targets are not as easily achieved. It's a very similar story globally. Chart on the right, obviously I said there's a lot more inflation protected securities when it comes to the US market. They've got this benign view as well. You know, you look at forward break even, these are forward 1-year break even of inflation rates that I'm showing you there for the next 10 years. I mean, they're pretty much around sort of that 2.5% that the Fed would love to achieve, at least in a core sense. So there's a bit of kind of convenience globally too. And if that changes, we inherit it into our market. So we still like inflation-linked government bonds. I'll just talk briefly about Kiwi and then I'll stop. Kiwi dollar, that is. So look, we've got a negative view on the New Zealand dollar. It's twofold. It's some of that sort of big picture external vulnerability dynamic that Kelly touched on. Ting kind of expanded on it too, the way in which, for example, a slowing China feeds into New Zealand. I mean, for us, from a currency point of view, it is just that we are externally vulnerable. We owe the world about half of our GDP. That's the largest amongst developed economies. And we run a current account deficit, which is simply just adding to that every year. And so when things perhaps become less certain, investors offshore become less confident, then we're just going to have to pay a higher premium to attract foreign capital. And the easiest way for us to do that is just to have a weaker exchange rate, make it cheaper for them via that channel. So that's one part of the story. And then the other is this idea that our short-term interest rates will eventually have the scope to fall quite meaningfully, we think, relative to other countries. And so an interest rate differential basis, but then a broader sort of external vulnerability risk premium story. Just in terms of a couple of models that we run, Kiwi versus the US dollar has really undershot our estimate of fair value. It's not particularly sophisticated. All we do is take 2-year interest rate differentials and proxy global risk sentiment with global equities. But that hasn't really explained at all the depreciation we've seen in the New Zealand dollar versus the US over the past 2 or 3 months. It's much more about sort of broad dollar strength. It's been about these external vulnerabilities. It's been about China, for example, for which this model doesn't sort of fully capture. So we're against this model at least somewhere around 2 standard deviations below what this model would say is fair value, but we can understand that perhaps we're in an environment where the longer term drivers are playing a part. Hasn't been the same way against the Aussie dollar. Chart on the right, Kiwi Aussie has been kind of trucking around what the model would call fair. But of course, if we overlay our view that we think that New Zealand interest rates can fall, eventually some way, particularly versus Australia, then, our estimated sort of fair value would fall with that. And so we still see that there's quite a bit of room for Kiwi Aussie to move lower. I'll just finish quickly with, long term. What do you use long term for currencies? I mean, to be honest, purchasing power parity is not bad. A long-term average is not bad. So what do these things look like? So Kiwi versus the US dollar on a purchasing power parity basis looks, undervalued. It looks, quite a bit below that. But I think what I'd want you to focus on for both of these charts, the chart on the right, let me explain it. This is the deviation of Kiwi dollar on a purchasing power parity basis, but on a trade-weighted basis, so against our trading partners, which looks a little expensive, about 20% overvalued on that basis. But I think the real focus here is what does the New Zealand dollar do when the world is not in a good place? So I've shaded out US recessions. You could do whatever you like to proxy a period of time where investors are cautious and they're thinking about what they need to fund a small open economy, vulnerable to natural disasters and so on and so forth. Well, if you look at the chart on the right there, they probably want you to look much closer to fair value on a purchasing power parity basis than to look above that. And so I think there is room on that basis for the New Zealand dollar, given the outlook we have, to continue depreciating. So quickly, what are we doing in portfolios? I think I've described it all. Our real conviction is around that short-term space, that, we don't think that monetary policy being tight forever is the right thing to price, and we're being patient about that, but we have that sort of position on. We're overweight in that part of the curve, sort of neutral to short, underweight beyond that. We still like inflation-linked government bonds. In FX space, pretty much across the firm, we think the New Zealand dollar can underperform both the Australian dollar, but more generally when it comes to multi-asset portfolios. So let me stop there and pass it back to you, Alister.
All right. Thanks very much, Hamish. So we have had some questions come through. We've got about 10, 12 minutes for questions now. The first questions naturally came through to talk about the bigger picture stuff that sort of Kelly addressed at the outset. So maybe we start there. We've seen 3 presentations today. Each person has presented a relatively bleak outlook globally, with some changing situations that mean it's challenging at a global level. Ting and the domestic economies presented some challenging pictures around dairy in particular, growth in general in New Zealand. And Hamish has said, well, hey, from a currency point of view and from a fixed interest point of view, yeah, there's some challenges here as well. So maybe at a high level, we'll start with Kelly. We'll hit the first couple of questions out of the park. Growth drivers. Will the downturn in China affect certain sectors more than others, or subdued demand for New Zealand exports? So that's a Kelly sort of Ting question.
Yeah, I mean, so from our perspective, where we really do see it in the commodities exports, so it is particularly in dairy and meat, and also in timber as well, because that construction sector was actually one of the sectors in China that took quite a lot of our logs. So one of the things we noticed is that the rate of deforestation was shut down pretty quickly, because they had nowhere to send the logs, especially when you consider that the New Zealand construction industry is actually pretty quiet right now as well, coincidentally. So sort of like those are the sort of key sectors we're seeing there. We're looking to see if it's going to translate through into tourism. And one of the interesting things that we've noticed so far is that Chinese tourism is actually still picking up. So that what that tells you is that this weakness that's going on in China isn't necessarily uniformly felt by everybody in the country. There's still that cohort of people out there, presumably higher net worth people, who actually have resources available to go out and do all the fun stuff that all the rest of us have been wanting to do as soon as they opened up the COVID restrictions.
Okay, so Ting, turning to that one domestically, you've painted a picture that dairy's got some challenges, particularly in the Chinese market. Are we going to pick up the slack from tourism? Is that going to be the answer? Are we going to be able to attract lots of Chinese tourists in to spend the money they have domestically?
Well, I think, I mean, like, definitely there is going to be like downward pressures continue like for commodity exports, but we also highlighted in our latest quarterly prediction is that we are seeing that sort of continued recovery in tourism and sort of just export of services more broadly. So we expect that will carry over through the coming years, and especially like with all the borders reopened, fully reopened, we're also going to see like increased inflows of, say, international students and anything that's sort of related to that sort of international visitor arrivals, and that will sort of flow onto some of the other, say, retail and services industries here in New Zealand. So that will, to some extent, will offset some of the weaker demand from China. And also, we're seeing that the horticultural exports are doing relatively better compared to other export commodities because of the fair trade agreement between New Zealand and the UK, and as well as because a decline in the export value, the export volume of say kiwi fruit and apples, like the harvest level, so that will support the export prices of those commodities.
Okay, so we've got some gaps that we can fill with some certain things. Kelly, question back to you. The Chinese middle class was supposed to be the engine powering a lot of their consumption. You've painted a picture that youth unemployment's probably making that wealthy middle class hold back from spending. Do you see that changing at any time in the future?
So the view there is that what we're really looking for is pretty significant stimulus from the Chinese authorities sometime soon to try to offset, this really large negative output gap that's accumulated there. There's been some measures taken by the Chinese authorities in the last month or so, which seems to have improved sentiment a bit, but the job seems to be pretty large. So we're all looking for sort of like much more expensive measures. Otherwise, you might just end up with a bit of a downward adjustment in the level of growth.
And do you think they'll get back to that 5% growth target?
Well, the challenge in that, if they don't get sufficient, basically no. You could be actually looking for a move back to sort of 3 or 4.
Okay.
And the reality is that for China, you've probably got to expect some deceleration of growth. They're not an 8% economy anymore.
Yep.
They're probably not a 1% economy, but they could easily be a 3 or 4.
Okay, so Hamish, let's kick it into the portfolio asset allocation type question. Do we hold China as an exposure in our portfolios, or do we diversify elsewhere?
It's an interesting. It's a massive economy, right? And so I think you have to be sort of almost sector specific when you answer that. They are world leaders in many respects when it comes to some of the innovation around, battery technology, for example. I think they were more onto that, at least onto it earlier than some other economies. And so I think we see there being opportunities in those companies that have been early innovators into sort of this new regime. And so, yeah, like I don't think you write China off wholesale, but you definitely don't buy China in the same way you did following the global financial crisis. You know, you don't buy on the basis of big infrastructure spend, on big housing support, residential construction, you know, metals and things like that. That's not the way to play China right now. So it's very selective. But I think the big message from us is, you know, on the equity side at least, is to, you know, there is still value within China for sure. From the fixed income side, you know, we just go up a higher level, right? We go into the macro, as Kelly says, this is an economy that is slowing both for cyclical and for structural reasons. It's our biggest trading partner. Perhaps it's not fully captured in the Reserve Bank of New Zealand forecasts. Therefore, we would expect with time that they revise their expectations of our trading partner growth, and with that feel that they don't need to have monetary policy as tight for as long as they anticipate. So there's sort of two different angles to that. And then, of course, the currency side, well, I think it aligns more with the fixed income, that, you know, this is something which ultimately means we are earning less foreign currency revenue and therefore buying less New Zealand dollars. It feeds into the view we have that, you know, the Kiwi dollar, we struggle to see that performing particularly well over the next, you know, year or so.
Okay, so the three of you's consensus is that growth is lower for longer, which probably echoes a lot of strategists around the world. We've got an election coming up. We're not going to talk about who's going to win or not. Kelly, you made reference to the fact that New Zealand needs more friends, effectively. What sort of policies, tariffs and things do we need to put in place to make more friends so that we can export more stuff that people want to buy at favourable prices?
Well, I think what I see from both major parties is a relatively consistent perspective that as a trading nation, we need to try and be friends with everybody as much as possible. Now, the reality is that in bad situations, that may not be possible. You know, for example, I think that's probably pretty close to what Germany's strategy was before the Russian war kicked off. But you can certainly try your best, but it really does point to the need to diversification. I think both major parties have identified India as one of the great opportunities for New Zealand in the next 10 or 20 years. The demographics in India are much better than China right now. There's a large kind of like population there that's growing that we could potentially be selling a lot to. And in the end, I think everybody probably would ideally like to see New Zealand sort of like export markets better diversified so that we're not beholden to any one particular country or market in the future.
Ting, in 30 seconds, what are we going to sell to India?
Well, because their population are rising, I guess their fertility rate is pretty high. So definitely, anything related to, say, like
milk powder, baby products.
Milk powder and baby products, and okay. Yeah, like food related products.
Okay, and Hamish, do we swap China for India in our portfolios if we could?
Oh, difficult. I think, you know, it's still a very much, you know, an emerging market. And so, you know, from our point of view, it's investable, but it's investable at the margin, you know, for most portfolios. Yeah, it's not something you're going to be able to substitute China for. But yeah, I mean, I am totally with Ting. I think, you know, that has all the characteristics of the new China. You know, they're not able to produce the milk that they need. And, you know, they really do love milk, obviously. And, you know, we have a natural place. Okay. And so, but that's a 10, 20, 30-year story, that is. You know, there's a lot of internal dynamics that need to be resolved there as well. So, but yeah, I'm hopeful that we can do that at some point.
We have run out of time, but before we go, let's go around OCR this time next year. Hamish.
3.
Oh. Ting.
5.
5. Kelly.
5 3/4 or 6.
Okay, cool. Right. So anyone that's in the CFA forecast lunch, that gives you some further information that you might want to use in your forecast for the following year.
Yeah.
All right. Look, I'd like to thank all of our presenters. That's been a cracking presentation. I've really enjoyed it. Great content. Thanks everyone for dialing in.